I guess with the biggest of that bunch, and that is Microsoft. I mean, they've been hitting it out of the park the last few quarters. Does that continue?
They're the Scotty Scheffler of software. And the reality is that, this is a company firing on all cylinders. In the AI revolution, they're really the one benefiting front and center in terms of everything we're seeing on cloud. I mean, I think when it comes to AI and it comes to this next stage of growth, this is going to be a $5 trillion market cap in the next 18 months.
And you're comfortable with the amount of money that they're spending on CapEx and the potential return on that?
You want them to continue to spend. I think they're spending maybe too little. And that's what you saw with Alphabet this week. This is an arms race going on. And Nadella recognizes this is the time, pedal to the metal. Because the demand, we think Street's underestimating demand at 15, 20%. So a lot of the bears, they continue to miss these stories because they're focused on, in those caves and hibernation mode. They can't see AI in the spreadsheets. I think Microsoft's a good example. Some of the parts, and continues to be a table pounder name.
Well, speaking of spending, I mean, Meta has been doing a ton of spending as well. Of course, a lot of headlines about some of the hires, the personnel spending that they've apparently made in order to attract talent here. What do you think Meta's transformation is starting to look like right now? I mean, we've gone from just a pure play social media company to that effort into the metaverse, and now clearly Zuckerberg really sees a future in AI.
Yeah, and Zuckerberg is a wartime CEO right now because he recognizes this is going to be not just the golden age for tech, but when it comes to Meta, that consumer AI revolution, I mean, they're going to be one of the ones leading it. And you start to monetize those billions in terms of from an install base, you're looking at a 4-digit stock in terms of Meta. And that's why it's good money to continue to invest. And I think the street is still, underestimating what this growth cycle is going to look like on the other side. And I continue to believe it's a fourth industrial revolution. And this AI party, it's 10 p.m. It was 9 p.m. And that party goes to 4.
With its price up over 1,000% since 2023 and almost 250% since 2024, NVIDIA has been among the best performing companies in recent years. But according to one Wall Street analyst, NVIDIA still has a lot of space to grow. According to Boston Consulting Group analyst Phil Panaro, the stock might rise 370% from its current price to $800 per share by 2030. That's a daring move, given that it's already the biggest firm in the world. Is the $800 price objective, however, realistic? Let's figure it out by doing some back calculation. Graphics processing units, GPUs, and related hardware and software are produced by NVIDIA. GPUs are extremely helpful for any work that demands a considerable amount of computer power, even though they were first created to process graphics for games. GPUs excel at these challenging tasks because they can perform multiple calculations in parallel. Processing engineering simulations, drug discovery, cryptocurrency mining, and their biggest task to date, training and processing AI models, have all made extensive use of them. The majority of NVIDIA's GPUs are sold to AI hyperscalers, who install them in data centers to build potent computing clusters. Although its revenue growth has been excellent, it is still growing. Data center capital expenditures, CapEx, were $400 billion in 2024 and are projected to reach $1 trillion by 2028, according to third-party studies that the firm frequently references. Given that the chipmaker made $115 billion in revenue from data centers in fiscal 2025, which includes the majority of 2024, it accounted for about 30% of all spending on them. In the event that this $1 trillion forecast materializes and NVIDIA continues to have a 30% market share, it will make $300 billion. If the forecast is accurate, the company's $149 billion in revenue over the last 12 months represents a 100% growth. It's still a robust and market-beating growth, but it falls well short of the 370% increase. Phil Panaro predicts will make it an $800 company. However, Panaro's appeal is for 2030, not 2028. Therefore, we must look beyond the NVIDIA-cited projection. NVIDIA's 2025 GTC event referenced a worldwide data center capital expenditure number that shows a 26% compound annual growth rate. Projected capital expenditures would approach $1.6 trillion if the data center sector could sustain that growth pace for an additional 2 years, until 2030. The company's revenue would reach $473 trillion, or a 217% rise, if it could sustain its 30% market share. This is obviously less than the 350% that NVIDIA would require to reach the $800 price goal that Panaro has set for the company. I therefore doubt that the chipmaker will be able to meet Panaro's goal in the allotted time. These estimates have still demonstrated that NVIDIA can be a very strong performer with market-crushing returns, provided the data center capital expenditure projections are fulfilled over the coming years, and the company continues to dominate its market share. Because of this, it's a good stock to purchase right now, and I believe it would be prudent for investors to add NVIDIA shares over the next months. Jefferies predicts that NVIDIA's stock of H20 AI processors won't be able to meet China's growing demand after temporary U.S. export restrictions were lifted. According to the company, NVIDIA has between 600,000 and 900,000 H20 devices on hand, but demand may reach 1.8 million. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now let's get back to the video. Jefferies stated, "We think NVIDIA will be able to satisfy reasonable China demand as long as the US and China are in a true state for trade negotiations." According to the company, NVIDIA probably supplied about 300K in 1Q25, which is about in line with pre-ban levels. Chinese internet companies and cloud service providers still prefer NVIDIA chips despite supply constraints. Jefferies listed 3 main justifications. 2. Superior cluster performance over local chips. 3. Restricted local chip supply. And 4. Its CUDA ecosystem. Jefferies anticipates robust demand to continue even for subsequent products that are degraded, even though the H20 is only useful for inferencing. According to them, a next-generation chip with lower memory requirements, the B30, is anticipated in the fourth quarter of 2025 in order to meet a probable new standard for export control of AI chips. Jefferies increased its estimate of China AI capital expenditures by 28% to $806 billion in 2025 and by 40% to $108 billion in 2025. Additionally, the company projects a 12% increase in electricity demand to 29 GWh. Although the second quarter's transitory decrease in capital spending by Chinese internet companies may be attributed to the availability of GPU rentals, Jefferies stated that this does not represent slowdown in internet players' AI efforts. According to Jefferies, the most significant feature of NVIDIA processors is CUDA, and the company does not have any supply constraints. Following the release of the Trump administration's comprehensive artificial intelligence strategy, which placed a strong emphasis on deregulation and infrastructure development, NVIDIA saw a 1.7% increase in value on Thursday. The 25-page America's AI Action Plan contains 90 policy recommendations to improve access to AI tools for U.S. allies, expedite the construction of data centers, and remove federal regulations that impede the development of AI. The specific regulations that are being repealed were not made public. The White House's AI czar, David Sachs, stated that the United States is engaged in an AI race. The plan calls for examining Chinese AI models to ensure they comply with state censorship and includes steps to counter China's influence in international governance bodies. According to Secretary of State Marco Rubio, the strategy is the worldwide gold standard for technology. In addition to opening access to federal land and introducing fast-track permitting, the effort encourages the construction of additional data centers in the United States. There will be less environmental control. According to reports, the EPA is getting ready to overturn a significant emissions conclusion, which might restrict future climate legislation. The deployment of AI coincides with increased emissions and power demands. According to Google's 2024 sustainability report, energy-intensive AI infrastructure was primarily responsible for the 48% increase in greenhouse gas emissions since 2019. The strategy is implemented as businesses increasingly rely on automation, despite claims that AI will supplement human labor. AI adoption has been directly related to job losses at Salesforce, Recruit Holdings, and other companies. The launch is viewed as investor-friendly by several analysts. Dan Ives, a Wedbush analyst, referred to it as a turning point and a significant advancement in the AI arms race. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
You and probably, welcomed. It's been kind of a dull last few weeks when it comes to market action. I don't expect that for this week. Now, of course, it's impossible to know how things will break, but there's just so much news to digest this week. So I thought it was an important chance for us to just take it back and look back at July so far. Each one of these candles represents 1 hour. The yellow line is a linear regression. So basically, if every close was just a point on a graph, like a scatter plot, the mathematical best line to represent those closing points throughout this month would be that yellow line. And then the red and the green lines are just simply one standard deviation away based off that price action. So a fancy math way of saying, hey, this is a reasonable bound for the price action over the month. And what you'll see is that we're at the higher end of the range, Nicole, but we're still largely within a reasonable range of trading. And if anything, probably still have a little bit of room, 10, 15 points. That's a moving target, though, to the upside, where you can see we have run into resistance when we've gotten near that one standard deviation to the upside. Certainly it acted as support as well to the downside. So not to say it'll happen that way again, but it is a reasonable mathematical kind of range for the market over the last several weeks, going back to July 1st as we approach the end of the month.
Okay. As you talk about dates in the month, how about seasonality? You're looking at that as well.
Yeah, just a quick reminder, something we've talked about quite a bit over the last few weeks and really throughout the month of July, looking at the seasonality chart for the S&P 500. What we've talked about is that this early part of July, and really the entire duration of July, if we're being fair, has been historically pretty strong. That's the yellow line on this chart, which is the 20-year seasonality for the S&P 500. Normally, or let's just say on average over the last 20 years, we're up about 6.5% for the S&P 500 through this point in the year. So far this year, we're actually beating that margin. We're up about 9% here in real time. But what I have highlighted is this consolidation zone between really, let's call it late July or early August, all the way through late October, early November. Now, nothing says this has to happen, but over the last 20 years, this is the average trade. Nice run up throughout the summer, sideways into the fall, and then the market resumes its ascent into the latter, last few months of the year, November and December.